Okay, let's start now. So let me repeat some of the material last week because it's closely related what we are going to discuss today. Then basically, as I said in the PPT, we are talking about core business combination. And as I also said, business combination in general or in common, whether you read or you hear the YouTube and whatever, they also call it merger or acquisition. Mostly they shorten it becoming M&A. This is also like a separate field if you are interested in dealing with merger and acquisition. So your client will be the company who would like to buy other companies or would like to combine some of the companies of theirs. Then it will be like one own department or one separate department if you are working in the public accountant like Ernst & Young, PricewaterhouseCoopers, KPMG, like that. Then, because we are in accounting we have different term. So it's specifically for accounting. So don't be confused later on. How come the name is different? Well, in POM, for example, I learned it's supposed to be merger. It's supposed to be acquisition. That's why I differentiate from the beginning that in accounting, we call it different things, different terms. There are 3 types, actually 4, but we are not going to discuss the 4th. So the first one will be, we call it statutory merger. Second one, statutory consolidation. Last one will be acquisition bigger than 50%. Okay. Let's discuss first about statutory merger.
Miss,
Yes?
is it really true that consolidation is the rarest out of the 3? Because when I search for the homework, it took me for hours just to look for the consolidation, while the others just, oh, I found it.
Which one? Statutory consolidation?
Yes.
Yeah, because it's not common to be done. Usually it's statutory merger or acquisition bigger than 50%. Correct.
But Miss, I found in one website it is said that it is a merger, like what was it? Yeah, pharmacy. I forgot what pharmacy it is. And at the other website it said that they are consolidating, not merger. And some also said it's only acquiring how many percent.
Yeah, correct. That's why they are using many terms for different purpose, right? That's why
I mean the company is same, but some said they are merging, some said they are consolidating, some said only acquisition, but the company that involved is the exact same company.
Nah, I know because that one is depending on the perspective of which theory that they are using, like which term are they using or referring to. So if accounting, that's why I give example, right? If A, company A plus B, and then becoming what? If statutory merger.
A
or B, yeah? Correct?
Yes.
So one of the company
Still alive, the others dissolved.
The other dissolve. Correct. Dissolve. So if you are seeing it from the perspective of accounting, then you can define as long as one of the company only dissolve or 2 of the companies dissolve, well, there is one still alive, then we can call it statutory merger, despite of any other people call it, this is merger, this is acquisition, this is what, like that. Usually if merger, the common definition is similar to accounting though. So either one still alive or both of them are gone, becoming one. That's what they call as merger, usually. Because merger usually also happen to bigger company buying smaller companies. Like you said, chemical companies, say I'm also having a small chemical company, but I finally found the cure for cancer, certain cancer, for example. Then you are Pfizer, the bigger company, and you want to buy mine. Then if mine is gone, then we can call it statutory merger in terms of accounting, like that. Okay, and then I continue to the second one. So I think in the PPT for statutory merger, I give example for XL Axiata, acquire, or bought Axis. What does it mean by dissolve in this case is when you trace the existing or the existence of the company like PT Axis Indonesia, then when you refer to the database of Menkumham, Kementerian Hukum dan Human Rights, then you cannot find it anymore. That's what I meant by dissolve. Okay, no miss, but I can see still the product. I can still buy the product. Doesn't matter. But the one that is referring dissolve here is the company existence itself. Okay, and then statutory consolidation is A plus B becoming
C.
Good. So in this case, both of the company are gone. Are dissolved. Now, this kind of condition in general knowledge, they also call it, look, this one also merger. Why? Because both of the companies are gone. Now, again, depending on which perspective are you seeing this one from. So again, if accounting, this one is not statutory merger, but statutory consolidation. Okay, because there is a new established company consisting of the previous companies that already gone. I think in my PPT, I give example for Kraft, used to be Kraft alone, and then Heinz alone, and then afterwards they combine together becoming Kraft Heinz. So if you take a look in the SEC, the same as Otoritas Jasa Keuangan in US, Securities Exchange Commission, then you will not able to see the listed or the Kraft Incorporation alone and Heinz Incorporation alone. So all you can see is Kraft Heinz together. So that's what the meaning of statutory consolidation. Okay. And then the last one will be acquisition bigger than 50%. Now, if this one, A plus B becoming A and B. So, yes.
Yes.
No one is dissolved. Correct. So why I mention here bigger than 50%? What about if I acquire only 20%? If you still remember our material about investment, if less than 20%, we don't call it part of business combination, isn't it? Because we don't have any significant shares or percentage. So we are nobody. But if you are, how about if having 30%? Last time between 20 until less than 50, we are having significant influence, right? But you are not the one in control. So even though you are saying no to certain decision making, it doesn't mean that the whole company will agree with you also saying no, because you are not the controller, you are not the majority. But without your presence, then the company cannot vote like unanimously. So in this case, the one that is part of business combination, we call it if you buy bigger than 50%, up to 100%. That's why I give example there, the Facebook and WhatsApp. And you are not only can see the products are still there, but both companies are still there. So WhatsApp Corporation is not gone. It's still there. But now the owners change. Used to be someone, I forgot the name, and now changed to Facebook. The same with Instagram. Okay, so that's why we can call that no one is dissolved. Both companies are still running as usual, but there are different shareholders now. Any questions? Okay, no? Based on these three types, we can categorize or make it into narrower type. So two types of business combination, which is with the solution. With the solution means one or more of the companies involved are gone. So this will be applicable to 1 and 2. And then the other category without dissolution, which is applicable only to number 3. Okay, today we are going to discuss further for the with dissolution. Okay, no questions, and I'll try to. Okay, I'll clear. Okay, with or without the dissolution. So whatever the form is, with or without dissolution, then the method being used, 2009 onwards, we are using what we call as acquisition method. Nah, be careful with the word acquisition. So acquisition in accounting can have several meanings, right? But out there, generally acquisition means one of the form of business combination. But before 2009, we are using purchase method. The one that we are going to discuss or learn is acquisition method. So with acquisition method, whether you are dealing with or without dissolution, with or without dissolution, there are several things that you need to be aware of. Number 1, the usage of fair value. Why? Because purchase method previously not using fair value, but acquisition method is using fair value or market price or market value. So fair value in bahasa we call it nilai wajar. Nilai wajar happens between seller and buyer without any restriction, without any pressure, without any special relationship. Say you are my sister, so I'll give you discount. You are my brother, you are my parents, you are my uncle, and blah blah blah. So there's no such thing. It's truly between stranger of buyer and seller, stranger to each other. Then how much is it? Usually it's being done by appraiser. There is a appraiser who is dealing with this kind of thing to determine the fair value. But if you cannot have access to the appraiser, the easiest one will be the market value. And then second one, you need to know who is the acquirer versus acquiree. So acquirer is the one who buys the other company. Acquiree is the one being bought. Okay, that's why I put it acquirer and acquiree to make it simple. And then you need to determine for the acquirer how much consideration transferred. It's the same with saying how do they pay and how much. Are they paying by cash? Are they paying by liabilities? Or paying by issuing shares like Facebook and WhatsApp? Or they are paying by the combination of 3 or 2. Okay, and how much? How much is it? And then from the query, you need to calculate the fair value. Remember, we are using fair value of net asset. Net asset is not assets, but assets minus liabilities. Plus, is there any separate, oh sorry, I put it like this. Plus, is there any separate intangible recognized? If you are developing brand, for example, and the appraiser can see that, oh, this brand has value, say Coca-Cola, McDonald's, then there is a brand value. We call it separate intangible if you still haven't included in your assets. And then minus consideration, not consideration, contingent. Contingent consideration. Contingent consideration is like you owe to the previous owner. You make a promise. If my company, after buying from you, can make the sales reaching to certain amount, then I'll give you bonus cash or bonus share. So there is a promise in the future if there is condition fulfilled. This is what we call as contingent consideration. Contingent means contingency plan, right? Can be launched, can be not launched. So depend on the situation, certain requirement. Fair value of the net asset, and then number 5, you compare between the consideration transfer versus the fair value. Consideration transferred by acquirer, fair value by acquiree. Whether there are 3 possibilities, CT equal to fair value, and then CT bigger than fair value, that means you are having goodwill, and then CT smaller than fair value, which means you are having gain on purchase. So that's the 3 cases or 3 possibilities. Which one happened mostly? Of course, the one with goodwill. So say Facebook, between Facebook, WhatsApp, Facebook, Instagram, behind the fair value of the assets and liabilities of the WhatsApp, there are also the employees who are expert or develop the technologies and the technologies that already developed, and also the subscriber that you cannot make it into value. Then to respect or to appreciate this kind of thing that you cannot calculate in numbers, then usually as the buyer or acquirer, you will pay more. Then the difference between this, how much you pay and then how much you get for net assets, it will give you goodwill. Goodwill is another type of intangible assets. The difference is you cannot amortize goodwill. If intangible, if you still remember, we have to amortize it, right? The same as depreciation. But goodwill is not going to be depreciated because we cannot make sure how long the useful life will be. So indefinite. That's why we don't amortize it. And on the contrary, say you pay less as a buyer or as an acquirer compared to what you got, then you are having more benefit. So having more like gain. So this purchase will be purchase on bargain because you can pay cheaper for something that's supposed to be more expensive. Usually this case is if the company is in the brink of bankruptcy and the owner needs money to cover all the liabilities or any other, then basically he just sell it with cheap one. That one, and then the last one, who should record the transaction. It's the acquirer. If the case is dissolved, it's very clear. The acquiree will be gone. So there's no point of them of recording, right? So definitely the acquirer is the one who should record. But in the case of acquisition bigger than 50% without dissolution, then both of the companies or 3 companies or 4 companies are all alive and still running the business. Then who should record? It's still the acquirer. Any questions so far?
Miss,
Yes.
I want to ask, what is goodwill?
Goodwill is like my example before between Facebook and WhatsApp. For Facebook is the acquirer, WhatsApp is the acquiree. Then WhatsApp needs to calculate how much is the net assets, correct? And then say they already calculate and the net assets of WhatsApp, for example, only 10 billion of US dollars. But Facebook is willing to pay 16 billion. Then what is the 6 billion difference? Because actually, if the net assets of the company is only 10 billion, yeah, you're supposed to buy only or to pay only for 10 billion also, right? But
yes.
in this case, Facebook is willing to pay higher. Why? Because they see that, number one, the subscriber of WhatsApp is already a lot overall the world. And then the technology is already developed. And then the employees are already there also, the one that is already experienced with this and that of WhatsApp. Then these 3, you cannot measure it in terms of assets and liabilities, right?
Yes.
That's what we can call them as goodwill.
Miss, so goodwill happens in the acquisition more than 50% only or not?
No, it happens to all. Statutory merger, statutory consolidation, acquisition bigger than 50%.
Oh, okay, Miss.
Yes.
Thank
Any
you,
other?
Miss.
Okay, and then business combination, of course, incur costs. There are several costs. There are 3. The first one will be direct costs. Direct costs, because the process is quite a lot and involving many parties, starting from the law. So you need the legal advice to make the statute and the legal document too. You need to pay attorneys. And then you also need public accountant service to double check or audit your financial statements. And then you also pay, for example, the bankers or financial institution if you are borrowing money from them in order for you to buy or acquire another company. So basically, outside of the company, which involved in the process of business combination, we call it direct cost. And then the treatment will be expense. Well, indirect cost is management time. So say you assign a group of people in your company to deal with this business combination. they do the feasibility study, they calculate how much, and then what are the possibility of paying the consideration, whether cash liabilities, shares, or whatever. Then they need to spend like longer time in working, like overtime. Then all of the costs that incur inside your company because of this process, it will be indirect costs, and it's also being expensed. The last one is of issuance, of share issuance. Sometimes the company is not paying cash, and sometimes the company is not paying only by cash and liabilities. Sometimes they are using shares to acquire another company. It's also happening between Facebook and WhatsApp. So if you read the news, the way Facebook pay to the shareholders of WhatsApp is not by cash, but it's by giving them the shares of Facebook. So in this case, Facebook needs to register the additional shares issuance belongs to them, and they need to register it with SEC, the one that I said before. Maybe here you need to register with IDX to issue additional shares. And this one, the treatment will be reduce or deduct additional PIC account. Maybe you don't know about what does it mean by additional PIC because this book somehow still using GAAP, but in IFRS, this is the same as share premium. Which one means there are three, it's all of them. So ordinary, preference, treasury. That will be the additional PIC. Deduct means you need to debit, reduce. Because this is additional PIC will be equity account, right? Share premium also equity account. The normal balance supposed to be credit. But this is deduct, reduce, so you need to debit it. Later in the problem, we can see clearer. Any questions so far?
Miss.
Yes, William.
How you calculate the indirect cost if it's based on management time?
It will be given in the problem.
So the example like what?
Like legal and accounting fees. Sorry. Like the salaries. Salaries of employee that you assign to deal with this business combination.
The salaries, yeah. Okay.
The salaries of your own employees.
Okay, thank you, Miss.
Yeah. Maybe you wanna save it first before I change to PDF. Done?
Then, Miss.
Okay.
Done, Miss.
So I'll stop. I'll change to the PDF. Okay. So the first one is problem number 11. Okay. I will just annotate here or write here. I think it's easier rather than I open two windows, like one Word and one PDF. Wait, where is my note? Okay. Okay, number 11. First of all, again, who is the acquirer? Who is the acquiree? That's the first thing that you need to know. Which one?
Acquirer Selinco.
Okay, the acquirer is here. Okay. And then the acquiree will be?
Corp.
And good. So this will be a query. Okay, then how much is the consideration transferred and how? How client co paid for this business combination and how much?
Uh, 800,000
Yes,
cash.
800,000 cash, good. So 800, this is cash. And then the next one will be, we have to calculate the fair value, right? Fair value of rent corp, a query. How much is it? Remember, we are taking the fair value of net asset. Net assets equal to assets minus liabilities and also plus separate intangible minus consideration, contingent consideration that you can find. In this case, we start with cash, yeah, 150,000. Any fair value of cash 150,000 being mentioned?
It's 150,000.
Yeah, if cash, yeah, same. Fair value, book value is the same. Good. And then, how about account receivable? Account receivable, 180,000.
180,000.
This is book value or fair value?
Fair value.
No, this is book value. The fair value is here. So it's not 180, but only
40.
Yeah. Next one, capitalized software cost. How much is the fair value?
200.
Yes.
200,000, this one is in process R&D. So research and development, but they are still ongoing. It's not the same with capitalized software costs, right?
Yes.
Then there is nothing, right? So we are still taking 320.
Wasn't it 140?
140, 320. How about goodwill? Any fair value?
No.
No, so we're still taking 100. Liabilities, any fair value?
No.
No, also, so 130 it is. Anything else we haven't inputted? Any separate intangible? This one,
No.
right?
Oh.
In process, research and development is not yet included in the one that we calculated before. Yeah.
Oh, yes.
So this one is IPR in process R&D. How much is that? 200. Any more?
No.
No, so that will be all. How much is that? How much?
680,000.
680, not 780?
Oh yeah. Oh witness, I calculated wrongly.
Yeah, 780, yeah.
Yes.
So 780,000. So this is the case of consideration transferred bigger than fair value. That means you are having goodwill equal 800 equal to 20,000. Correct? And then there is no information whether rent is dissolved or not. So because we are learning the dissolution today, then assume rent is dissolved. Line journalize the transaction by debit cash, debit AR, 150, 140, capitalize software, 320, and then goodwill, we are having 100, and then be careful, liabilities not in debit but credit. Liabilities, how much is that? 130. And then how client is paying cash, so cash credit. This is cash. Now, if you stop up until here, the debit amount and the credit amount will not be the same. Because we forgot one more also. In process R&D, how much is that? 200. Liabilities, how much is 130, 30, and then cash 800. Okay, then again, if you see this one, debited amount and credited amount not the same, then of course it will give you another goodwill as we already calculated before, which is 20,000. Then now let's go back to the problem. What are the questions? How much is reported for goodwill?
20,000.
How many goodwill do you have?
Oh, 2.
2, yes. The first one is coming from rent itself, 100,000, and then the other one is because of the business combination, right? 20,000. So the answer will be
120,000.
yes. Any questions?
Miss, so the debit and the credit must be balanced, right? So if it's not balanced, so the goodwill, we add the goodwill in the debit.
Yes, goodwill must be in debit because that one is intangible assets. On the contrary, if you need to credit, then it will be bargain on purchase.
Oh, okay, Miss. Thank you, Miss.
Yeah. So wanna say first?
In what miss is this shot, miss? Oh, in progress already. Okay, okay, okay. Miss,
Yeah.
why the goodwill written twice?
Because to differentiate, the first one is coming from rent itself.
Oh, that's rent goodwill. The other one
The one
we
we
pay more.
have it because we pay more. It's okay, you have to write it twice like that because it's making you easier in checking. Can I continue then? Have you saved? Or question?
Already, Miss.
Okay. Okay, I will scroll down.
Miss,
Yeah.
why the liability 150, miss?
Oh, 130.
No, the final calculation.
Yeah, 130. Not 150. Maybe the way I write. Sorry. I cannot write neater than the liability is still this one, William. Still the same, 130. Okay, then let me continue to the problem 12 and 13 relate to this problem. Again, determine first who is acquirer, who is acquiree.
Beasley.
Who is?
Acquirer.
Yes. And then acquiree?
It's
Donovan.
Donovan.
Yep. And then again, how much is the consideration transferred?
For in stock.
Yes, this one, right?
Yes.
So this time the acquirer is not paying by cash, but using stock. It is 400. Now the next one, how much is the fair value of net assets? How to calculate? First of all, let's read this one, current assets. All of this 90,000, 220, 60, 150, 100 are all based on book value. The one that we look for is fair value. Where should we look? To the explanation below. Okay, and then first of all, from this problem, we can know several things. Yeah, assets and liabilities of Donovan, which will cease to exist as separate entity. Cease to exist, so that means in this case, Donovan will be gone or dissolved. So we don't need assumption, it is being informed directly that Donovan will stop to exist. And then, in connection with the merger, Beasley incur 15,000 in accounts payable for legal and accounting fees. What is this? Direct cost, indirect cost, or registration cost? To pay legal and accounting fees.
Indirect cost.
Managerial.
Yes, direct.
Oh, direct cost.
Yes, you are not paying your own employee, right? If legal and accounting fees. So direct cost will be 15,000. Paid not by cash, but paid by AB. Okay, then let's continue. Besides that one, Beasley also agreed to pay 75,000 to the former owners following year. So still next year.
AP again.
Yes, if requirement fulfilled.
Oh,
75,000, you still pay it next year. Then you don't need the 75,000 in the next year, but you need to know how much is the present value of 75,000 now. How much is it now? You don't need to calculate because you haven't learned Finman, right? So directly they are giving you the information that the present value of this 75,000 1 year later, the present value of 75,000 that you need to pay 1 year later now is equal to 20,000. So in this case, this one is contingent liabilities because you owe to the former owners if Donovan can meet certain revenue goals.
Is for the contingency, is it always stated in the question if there is contingency like that or not?
This is the example of the way they tell if there is contingency.
Oh.
But you don't need to calculate the present value. It will be given.
Oh, okay, Miss.
Then let's continue. There is another note that Donovan holds building with fair value of 30,000 more. So this one is not 220, but later you will use 220. Right? 30,000 more.
yes.
Current asset, there's no more information, so 90,000. Before we continue to calculate the fair value, we need to go down. Is there anything else or not? Then, wait, let me go down. Nah. Now, beside that fair value 30,000 more for the building, there is another one, right? Unpatented technology, not yet included, above 25,000. And also research and development activity in progress or in process, same with the fair value 45,000. Then book value for the others for current asset and liabilities are all exactly at fair values. So now we can calculate the fair value. Let's go up. Okay, starting from current asset is already fair value. Building,
Plus
adding
30, 50, 20, 50. So 150.
Good. Anything else?
Uh,
And
on pay. Huh?
patent technology, right? From below, the
Oh,
one is red. And then we also have in process. R&D 45,000. And then building equipment done minus 60,000 for liabilities, right? And
Yes.
don't forget the contingency, 20,000, because we don't pay now, it's still next year, so it's contingent liabilities. Is there any other?
so we don't use the 75.
75 is the amount for next year. We need to get the present value of 75,000. How about 15,000? Is it included in the fair value or not?
Yes.
No, this is the,
Oh, it's the direct cost.
yeah, separately it will be expense, right?
Yes.
Any other? How about common stock? How about retained earnings? Should we include it? 150, 100,000. Should we?
Yes. Yes, Miss.
Any other answer? Is that Christine?
So it's not included, Miss?
Is not. Why? If you remember our formula, the only one and the only assets equal liabilities minus equity, right? In this case, assets minus liabilities equal to equity. So
Oh.
you want to add them up in mathematical, should we include all of them or only one side is enough? Because assets minus liability is equal equity.
Oh, so So we don't include it.
Yes, because actually you can choose, right? You want to include assets minus liability or equity. But in the case of business combination, the accounting entries is demanded to be the more detailed ones. If you only give us equity amount, we don't know how much asset this business has, we don't know how much liability that this business still has. So that's why we prefer the left-hand side rather than right-hand side or equity. So with this equation, with this understanding, you never ever edit the common stock retained earnings or all equity accounts of a query. Never. So basically, we already have this assets and liabilities. How much?
90,000 plus 250,000.
Yeah, plus 25, plus 25,000 plus 45 minus 80.
Wait, Miss, I calculate it.
Thank you.
Yes, you're welcome, Miss.
300. 330. Yeah.
Yes, Miss. 330.
So 330, and this one will be 330. And this is the case where consideration transfer bigger than fair value. Then there will be goodwill equal 70,000. Correct?
Yes.
And Beasley reports current asset 90,000. Building and equipment 250 debit. And patent technology 25. In process R&D 45. Liabilities 60,000. Contingent liabilities 20. And then Beasley is paying by stock. We don't know the details, we don't know the par value. So just assume share capital dash ordinary 400,000. Again, debited and credited amount is not balanced, then it will give you goodwill 70,000. And then the direct costs, you record it separately. Organization expense, which is 15,000. Credit, not cash, because you are paying with AP, 15,000. Any questions before we look at the question of the problem? Any question for the journal entries, I mean?
Miss, so the registration expense is only includes share issuance, right?
Registration, oh yeah, registration expense only involve or include the registration of issuance shares. In this case, there isn't. Even though Beasley is paying with shares, right?
Yes.
It's also possible Beasley is doing buyback shares, and then from the treasury share or buyback shares, he use it to buy another company. That's also possible. So he doesn't need to issue anymore. That's
Okay,
another
Miss.
if yes. Then how about the answer for the number 12? How much is total liabilities incurred?
Uh, 60,000, Miss.
Only 60? Look at your journal entries. Only 60?
Uh,
Six
how
plus
much, Miss? Oh, it's 80,000.
plus 20. One more. Ini AP. Also liabilities, right?
95,000.
Correct. How about number 13? Wait, let me go down. Here is first. He's asking about total assets. How much?
Miss,
Yes, William?
why
Share capital is at credit.
Ayo, chapter 13. If we are issuing shares, share capital always in?
Oh, okay. But that, hmm, hmm.
So the assets is 480,000.
How much? 400.
And 80,000, is it right?
No. Must be based on fair value. This one, 330,000 already deducted by liability and contingent liability, right? So if I don't include or do not deduct 80,000, then it will give me how much? Total assets are only this one, this one, this one, that one. It will be 410. Yeah.
Oh, yes. 410.
Any other questions from this number? Guys, any other question from this number?
No, miss.
Okay, then I'll go on. Can I erase or you still want to save the screen?
Oh, you can erase it, miss.
Okay. Okay, then number 14. I skip it directly to 15 until 18 so you can do your homework. And it's also clearer by doing 15 until 18. So again, who is the acquirer and acquiree?
Acquirer is True Data Company.
Yes, this is the acquirer. And then acquiree will be?
Webstat Company.
Yes, good. Then how much is consideration transfer?
10,000 common, 10,000 shares.
Times?
5 par value.
Par value or market value?
Oh, market value. So it's 40.
Yes, so 40 then equal 400, yeah.
Yes.
What about the fair value?
$40.
I mean the fair value of the net assets of website. Here there are two amounts. This is website book value, this is fair values. Which one should we take?
The book values. The fair values, miss.
Yeah, the fair values. There is no other information below. So then
300. Is it 385, miss?
385 coming from 60 plus 175, yeah, 200,
Yeah.
2275 minus 350.
Yes.
How much is it? 385.
385.
Okay, thank you. So this one again, CT bigger than fair value. Then there is
That means the goodwill is 15,000, miss.
good 15,000. There is no information whether website is dissolved or not, so assume website dissolved. And through data, what is that? Oh, sorry. Records cash and receivables. Inventory. $175, 3,000. Then that 200. And then 225. Equipment. Building and equipment, 75. And then what else? Liabilities. Liabilities, 350. How much is the share capital, guys?
Uh, 385.
No. Share capital.
Oh, wait.
300, 300,000.
No, it's not 300,000. Number of shares times with par value, right?
Oh, yeah. So 5 times 10,000, 50,000.
Okay, then we need to credit share.
Premium.
Yep. Premium, ordinary. How much?
350. 350.
Yeah, good, 350. Then the goodwill must be here.
385.
The goodwill 385.
Sorry. No. Wait.
It's not balanced between debit and credit. So this
15,000,
one.
sorry.
15,000. Yes. Okay. Any questions up until this point?
No.
Okay,
Miss, can you repeat the share capital ordinary where we get it from?
number of shares times par value.
Oh, okay, Miss.
Open again chapter 13.
Okay, Miss.
And I'll go down to check the questions.
Number 15 is PM, 15,000, like recorded.
Correct. 15,000 because there is no goodwill in website, right?
Yes.
Then we go down. $16.
Patent technology. Oh, 200,000.
200,000 is only from website.
Yeah, from fair value. So we need to have the book value, isn't it?
No, you have to add it to true data, right?
Oh, so 200,000
true data
plus
is how much? Let me go up again.
the 230.
So 230
Patented
plus 200. That's
200.
technology. Yes. And if there is
So after the acquisition, we add the values, miss, from the acquirer. Sorry. It's asking for the acquirer, miss.
It's asking for the
acquirer, yeah, if I'm not mistaken.
Yes.
Okay.
Always
So 230 plus 200, yeah. I thought it was acquired.
No. How about the common stock? Common stock is the same as share capital. Number 17.
But how do we know the amount of stock being purchased, miss? Oh, wait, there is, yeah. Common stock. So 370,000 supposedly.
So no, not 300. Remember, we never added the equity of the acquiree. Never.
But they bought the web something. Web stat. They use in the problem they use the 10,000 stock to buy the every outstanding stock from the website, right, miss?
Yes, but it doesn't mean that you are adding the equity of website to true data, right? Kan previously
yeah.
You want to choose assets, liabilities, or equity alone.
But do we add after the acquisition, the common stock from true data is 300,000, but after the acquisition it should be added, miss? No?
Are you issuing more from the acquisition?
Isn't the true data issuing common stock to buy the stock from website? So I assume they did.
Yes, correct.
So 350,000.
300,000 plus 50,000. 350,000.
Okay.
Plus this one. How about share premium?
Share premium, 350,000. Where's the
after the acquisition?
Oh, 360,000 for the share premium. Wait, miss, share premium is the additional pay-in capital, right?
Yes, same.
Okay, so
yes,
after the acquisition, that will be 360,000.
Correct. So 10,000 plus this 350,000. Good.
Okay.
Any questions before I continue to number 18?
I don't.
Okay, no, then number 18 is written earning, I think. Wait. Yes, written earning.
Retained earnings then,
Retained earnings in July. Careful. July 1st. Let me go up. So how much is return earning on July 1st? Be careful. This one is 1st of January. They want the 1st July. How much?
130,000. I don't think it's affected, miss, because there are no cash getting in and there's nothing added.
What else affect return earnings? This one definitely cannot.
Yeah, cannot.
What else? 130 is only 1st of January. The revenues and expenses, right? Not
Expenses.
income. Yeah. So
130 is not being. It's not counted. Okay.
yet included with the revenue until July 1st and expenses until
So
July.
we add.
Yeah, we add revenue
80,000.
250 minus 170.
210,000.
210.
Yes. Plus. Oh wait. Plus
No.
80,000, right?
Plus 80,000 from.
Oh, sorry. 250,000 revenue minus expenses equals to 80,000. So I add 80,000 to 130. So we get 210.
Yes. So if there is a question, how much is the, like number 15 here, but the question I replace it with cash and receivable, what is the answer?
Um, 60,000.
No. You add.
Oh, wait.
140,000.
200,000.
Yes.
Yes. Inventory?
We add 190 and 145, so we get 335.
Not 145, but
175. So 365.
so you're not confused. Make sure you take the fair values.
Fair values.
And if land 400 plus 225. Yeah.
625. Okay.
Holdings 100 plus 75. Liabilities 540 plus 350. Done. This one again, not included, not included.
Miss, but
Yeah.
what if Webstat has any unpaid preference shares, for example? So True Data has to pay for the preference shares also.
Wait. How about if Webstat has preference shares?
And yeah, the preference shareholders
Mhm.
didn't get their money. So if True Data acquire Webstat, that
Mhm.
means True Data has to pay for the preference shareholders too.
So depending how many shares or how many percentage True Data acquire, if 100%, then of course all common stock and also preference shares must be bought by him.
Even though there are any unpaid preference shares.
Yes, everything.
Oh,
So later on, the retained earnings will be less because Webstat hasn't paid the dividend, for example, for preference share.
okay.
Then it will reduce the fair value of the net assets, right?
Oh yeah. For example, if True Data wants to acquire everything, right? So
Mhm.
that means if there are any unpaid, does the True Data bought it first or they pay first, then they buy it?
When they calculate the fair value of net assets, they will calculate how much is the ending balance of retained earnings, right?
Yeah.
Nah, if you haven't paid the preference dividend, then they will deduct your retained earnings.
Oh, so
So,
they deduct first, then they bought. Okay.
yeah. So they calculate everything beforehand.
So the retained earnings is not being given to the liabilities first, but
No.
being given to the preference shares first, then all the outstanding voting shares are bought,
Mm,
then all the liabilities from website is being transferred to True Data. So True Data will be responsible for all the liabilities.
correct. So in this case, they acquired the 350,000 liabilities, right? It doesn't
Yeah.
mean that they pay it first and then buy website. No. Yeah, when they are buying website, later on they will be in charge to pay the liabilities of 350,000. Correct.
Okay. Okay.
There are two ways in buying other company, like the PPT also mentioned. You are taking over all the assets, so net assets only. Assets only. So then the company that you bought already settled their liabilities, so you only acquire the net one without any liabilities, or you are buying through shares. If you are buying through shares, mostly you are acquiring all, including assets and also liabilities.
The more than 50% of the shares.
Yes,
Oh.
because if not bigger than 50%, it will be investment only, right? You don't need to do this. By the way, if next semester we are having options, whether you got a book or soft copy, which I don't know, which one will you prefer?
The book, miss. Obviously, miss.
It is harder without the hard copy. But I'm not sure
Yeah.
how can we deliver to you. we haven't had any meeting about it. Okay.
Okay. It's much preferable reading through papers, miss.
Oh. Yeah, there is someone asking. Wait. Oh, Quintanilla. Still not sure. Because up until now, we don't have any announcement from the rectorate yet, whether it is going to be online or offline. But say it is offline. Do you dare to go out?
Well,
Huh? Okay, any other question, guys?
No, Miss.
No? Then that's all for the material for today. So next week we still have class, and then 3rd of June, yeah, 3rd of June is our last class. The final exam will not be in the video, but still through Google Classroom. Okay then, if you have no more questions, then I'll see you next Wednesday.
Miss.
Yeah.
So the final exam is in Google Classroom. It is we do it like the midterm, right, Miss? So we don't have to do the presentation.
No presentation, but maybe I'll change the form. Not exactly like midterm.
Oh, so it's not presentation.
No, it's not presentation.
Oh, okay, Miss.
Yeah.
Thank you, Miss.
Bye guys. Stay safe.
Stay safe, Miss.
Thank you, Miss.
Thank you, Miss.
Thank you, Miss.
Miss.
Bye. If you still have questions,
thank you, miss.
yes, bye.